I would like to talk about the closing process, starting with temporary accounts versus permanent accounts. At the end of the period, we have certain accounts that we want to clear a value to prepare them for the next period. Those types of accounts are called temporary accounts, and we'll discuss those here in a second. Those temporary account balances are then transferred over to permanent accounts, ones that accumulate over more than one period of time. Okay? There is a four-step closing process that we must go through at the end of each period to close those temporary accounts and transfer them over to permanent accounts. The first step is closing our credit balances in revenue accounts to the income summary. The second step is closing debit balances in our expense accounts to income summary. Close our income summary account to retained earnings. And 4, close our dividend account to retained earnings. In this case, the temporary accounts are our revenue accounts, so any revenue we have, our expense accounts, income summary account, and dividend account. The permanent account that all of these will be transferred to is the retained earnings balance. Okay. So I have given you an example here of how to go through the closing process and record those journal entries. Step 1, you're going to close the credit balances in the revenue accounts to the income summary account. To close credit balances, you need to debit all of those balances. So you do the exact opposite. So if you have a credit, you will debit those accounts. If you have a debit, you will credit those accounts. So in this case, we have fees earned, which is a revenue account, and we have income summary, which is the temporary account that we are transferring that to. So fees earned has a debit balance of $500, which means to keep our accounting equation equal, our income summary account will also have $500. Step 2 is closing all of our debit balances in our expense accounts to income summary account. So if we have debit balances, we must credit those balances in order to close those temporary accounts. So you see now that the income summary account is listed first. Why? Because we closed all those temporary accounts for expenses by crediting each one. And before we just throw in the balance up there, we have to add all of these together. So the 300 plus 600 plus 100 plus 200 gets us the $1,200 recorded in income summary. Step 3, closing the income summary account to retained earnings. This is when we transfer over the temporary accounts to a permanent account. The way we would do this, and the way I like to do this, is to draw a T account for income summary, and then look at the first 2 entries we made that deal with income summary. We see in step 1, we've credited income summary for $500, which is why you see it reflected on this side of the T account. In step 2, we see that income summary has a debit balance of $1,200, which is why you see $1,200 reflected on the debit side. We find the difference between the two and record it on the side that has the higher balance, okay, which has more. In this case, it's the debit side. This is before we close this income summary account. To close a debit balance in our income summary account, we have to do the opposite and credit that account. Okay? Which is why you see income summary here reflected on the credit side and retained earnings reflected on the debit side for that difference of $700. Now, let's say that your credit side was bigger than your debit side for the income summary account, and your balance was on the credit side. To close that, you would need to debit income summary. Step 4 is closing our dividend account directly to our retained earnings. So dividends have a debit balance. So in order for us to close the dividend account, we need to credit dividends and debit retained earnings.